Welcome, everybody. I'm sorry we don't have our traditional breakfasts. We owe you a double portion next year. Thank you for bothering to come. And I know it's not as pleasant to have it like this. I'm here with Brad, that you've all met before, and Mark Lavelle, that those who came to the breakfast before also met. Basically, what we do, sorry for those who already know this, and we try not to change our business model because we think it's excellent. We basically do a buy and build in the scientific instrument market. We feel it's a fantastic market to do that because of good long-term drivers, and we'll come onto that a bit later in the presentation. A large pool of potential acquisitions and low capital requirement. And these are really the three pillars of the building up of shareholder value, which has been quite well for 14 and a half years, a bit less good the last 3 weeks. But we think it's a very good long-term environment to do what we do. We've done 17 acquisitions since May 2005. Not so many in the recent past, although we did a small one in December. We'll come on to that. And we don't do a lot of deals, but we try to do deals that we won't regret. And so we're very disciplined. We're trying to buy only sustainable businesses at sensible prices. So this one shows the history of our acquisition. It's interesting to see, very spasmodic. You have a few years where we do nothing because we haven't found something we really like, or we haven't been able to complete deals we wish to do. It's not always price. And there's some fantastic years, and the good years for deals are not always the good years for trading. Like our best years ever was 2016. We managed to do 4 deals, and it's actually our worst year for trading. So you can't really say what will direct the speed of deals. All the companies we bought are in the UK. The most northern one is the last one we did in December, but it's very much concentrating in the southeast. And the little dots you see in the US are just sales office for 3 of our companies. This gives a bit of an idea of the customers of the group. I mean, we really focus mostly on research, also on optimization of industrial process and compliance with laws, to a certain degree on education. So we have a lot of universities. We put some of the most prestigious ones, but we have a lot more. There's also on the slide, a few examples of the companies we deal with. A lot of them are real blue chip companies. And then we have institutes which are either test houses, a lot of test houses like Exova, and institutes which are not universities, but which are doing very advanced science, like the CERN and the Allen Institute. At the bottom, we put OEMs, because when we sell an instrument to an OEM, we don't always know where it goes. And this is just a little sample of the OEMs that we deal with. So the key messages really today are, we had a really good year. It was our best year. We had a record in many of our KPIs that we use. All our financial metrics grew. We were, the things which influenced this was, among others, continuation of very good foreign exchange rates. And as a result of this, we're proposing a 25% increase in the annual dividend from 40p to 50p. I remind you that our policy, if you don't know, our policy is to increase the dividend 10% a year and not less. We've done this for the last 14 years since we've started paying it. But on average, of course, when we have a good year, we have to increase it more because 10 years is a bad year. And we had a very good year. So we've increased the dividend 25%. And the compound growth rate of dividends since we started is 24% and a bit. Organic growth, most of the growth is organic because we only bought Moorfield in December. So it's a very small contribution. And the growth this year was driven by really big efforts driven by Mark on operation excellence, which started, of course, the year before, but it takes a bit of time to bear its fruit. Continued R&D investment. We invest about 6 million in R&D every year. And we, of course, benefited, as always, from diversification in geography and markets. The outlook in 2020, well, the year started slowly, and of course, the whole environment is clouded by COVID-19. We're all at home. The world as we knew is suspended for a period of time. We don't know how long it is. And of course, it's affecting our business, and we'll talk about it also.
And we're now going to take you through the key highlights from the past year. We had a positive year in 2019, with revenues up 6% to 82.5 million, up from 77.9 million last year. This growth, which was almost entirely organic, enabled profits to grow strongly to 17.4 million, an 18% increase from the prior year's 14.7 million. And this has flowed directly through to earnings per share, which progressed to a record 222.5 pence, up from last year's 183 pence. Supporting this growth has been the operational improvements encouraged by Mark, our Group CEO, and our order intake, with healthy but uneven growth of 3.3% during the year. Our total order book was over 3 months at the year end, and I'll return to order intake later. We have a strong track record of converting profit into cash, and this year we generated 19.1 million of cash. This funded our growing dividend, up 25% to 50 pence per share for 2019, and also a further distribution, the payment of a special dividend of £2 per share in December 2019, totaling 12.4 million. Further, as a buy and build group, we completed our first acquisition for some time with the purchase of Moorfield Nanotechnology in December 19, and as David already mentioned, we'll talk through this a little bit later. These outflows, offsetting the strong cash generation, resulted in a net debt position of 2 million at the end of the year, with cash balances of 14.1 million, meaning our balance sheet at the start of 2020, as it was at the start of 2019, is very strong. As disclosed in the results announcement, and given the current uncertainties regarding COVID-19, and much concern over the ability to weather this unprecedented situation, we still retain a strong financial position with high cash reserves, low gearing, and significant headroom on all our covenants. In summary, 2019 was a record year, but also importantly, we're well placed and well primed to navigate the choppy waters of 2020. Moving on to performance slide. I won't dwell on 2019's results for long, given I've already explained most of the current year performance, and I will talk through the components of the growth in profit shortly, but I will note the following. The impact of the new accounting standard IFRS 16 had a minimal effect on the P&L, with our EPS being under 1 pence lower as a result of the accounting changes. Also, our effective rate of tax on adjusted earnings was 14.7%, slightly below the 15% effective rate in the prior year. This arises primarily from the excellent benefits our group derives from the UK R&D tax credit scheme, which is very helpful for groups like ours who invest in R&D and are also below 500 employees. Lastly, for those of you not as familiar with our P&L, we do have adjusting items which take us to the statutory result. The largest component by far is non-cash amortization of the intangible assets that we are required to recognise when we acquire businesses. Supporting performance has been our order intake. This really is the bellwether for our business. To explain to you about the graph, we have 3 lines on it, a red line, a black line, and a green line. The far right of the graph is the end of December 2019. The red line is our internal sales budget, which we set every year as part of our budgeting process, and is otherwise only updated if we have an acquisition. Note that in this case, we didn't amend the end of 2019 to reflect the acquisition of Moorfield in December, given its proximity to the year end. The black line is our trailing 12 months of orders, and the green line is the last 4 months of orders annualized. What we're looking for is for the black line to be at least around the level of the red line by the end of the year, such that there will have been orders equivalent to the full year budget. At the same time, we'd like the green line to be tracking the red line, although we know this will be more jagged, as it is a shorter term measure, and order intake is never completely smooth. As you can see, the black line was level or above the red line for most of the year, but the green line fluctuated more, hence our description of healthy but uneven order intake in 2019. Lastly, you can also see from the green line on the right-hand edge of the graph that we ended 2019 not quite as buoyantly as we had in the previous 2 years, although still with a robust order book of over 13 weeks, which was consistent in actual size to the order book on the 1st of January 2019. The start of 2020 has, however, been slower for orders than the same period in 2019, and we inevitably expect further challenges as scientific conventions are cancelled and travel to customers has all but ceased for the time being. We continue to be a high exporter, with over 85% of our revenues delivered across the globe. 2019's growth was driven by strong performance in both China and North America. This slide reconciles between the 2018 and 2019 profit contribution of the businesses, excluding central costs. You can see that our family of businesses performed really well overall. as seen through the big green block of organic growth, but that some of our companies also fell behind their previous year's performance. The third block shows the impact of the acquisition of Moorfield, which added minimally to profit. Overall, though, this shows a very strong picture of our group performance last year. Moving on to the balance sheet and cash flows, and given the current situation with COVID-19, I may dwell here a little longer than usual. The group has an excellent track record for cash generation and a strong overall financial position. Little has changed on this since the end of last year. We generated 19.1 million of cash from operations at a cash conversion of over 100%. As mentioned earlier, our working capital is consistently less than 10% of revenue, so we do not have to invest cash into working capital to support growth. We're also privileged to have a blue chip customer base of both universities and also industry, as you saw earlier from the overview. We consequently receive timely payment of our invoices and experience minimal bad debt. We, in return, agree reasonable payment terms with our valued suppliers. In 2019, and in following our strategy of generating increasing returns for shareholders, we were able to support an increase to the annual dividend of 25% to 50 pence per share, and also funded a special dividend of £2 per share. Total dividends paid were a shade over 15 million. We also completed the acquisition of Moorfield for 2.3 million and only moved from a 0.9 million net cash position at the start of 2019 to 2 million of net debt by the end of the year. This low gearing is a result of our conservative approach to debt. In entering 2020's period of extreme uncertainty, we have high cash balances of 14.1 million and only the requirement to repay around 3.5 million of debt and interest each year to the bank, as you can see from the cash flow. We remain grateful to Lloyds Bank for our acquisition financing, and with whom we've had a long-term supportive relationship throughout the entirety of Judges' life. And we have significant room on all our bank covenants. Overall, we have a strong financial position with which to face the challenges ahead. The key measure for the group is the return on total invested capital. In its simplest form, it's a function of the multiples we pay for the businesses we acquire. We started around 20% when we paid close to 5 times for FTT. Growing ROTIC thereafter either requires improving financial performance and or acquiring businesses on lower multiples. The dips you can see in the middle of the graph in 2012 and 2013 relate to our larger acquisitions of GDS and Scientifica, where we paid a multiple of 6 times profits, and in 2015 when we acquired Armfield. Smaller acquisitions impact less on ROTIC now. We ended 2019 with a pleasing ROTIC of 31.4%, improving from 27.6% in 2018. We continue to strive to improve, although noting that it will be challenging to maintain this in the current climate. The next slide shows a split of revenue from all our businesses and is useful in showing that no single company dominates the group. Additionally, our businesses manufacture instruments for different scientific markets to each other, so we're also diversified by scientific application. Lastly, in terms of geography, we export more than 85% of what we sell, and as you can see, no single region or country overly dominates. Lastly from me, you can see the next slide summarises some key financial statistics about the long-term success of our group. Revenues and profits and earnings per share have grown strongly over the history of the group, and in 2019 we've had record revenues, record profits and record EPS. Compound organic annual revenue growth is 9%, which for a group which executes a business model in buying businesses with sustainable profits is creditable. Dividends have grown at least 10% per annum, and this year we've increased the full year dividend by 25% to 50 pence, and the compound growth of the dividend is 24%. Lastly, the group's continued focus on cash generation serves to ensure that we have the capacity to weather challenging market conditions, quickly reduce acquisition debt and fund new acquisitions, together with growing dividends for shareholders. And I'll hand you back to David to discuss our strategy.
Thank you very much, Brad. So the growth drivers are really acquisitions and organic. So the thing which drives M&A, and we've talked about this, and we'll go a bit further into details in a few minutes. But really, we have to understand that our sector contains many global niches. It doesn't mean that every instrument business is a niche business, but the very diverse environment that we operate in contains a lot of small global niches. And what we're trying to do is we're trying to buy companies which have a strong position in a global niche. When we started, there was 2,000 privately held businesses in the UK. We bought a few, but we left a lot. And of course, there are such businesses created every year. So this is really, quite a good pool of deals. And of course, they're not all niche, but some of them are. And because there's a lot of them, we can always find some nice ones. And every year we find a lot of nice ones we want to buy, but of course we don't always manage to do that. Organic growth is driven by several things. The long-term secular organic growth in science is predominantly due to an explosive growth in global higher education. People talk a lot of China these days. I read in an article recently there's 270 million students in China. You imagine how much the Chinese government needs to spend on equipping its 1,000 new universities. And the other driver is process optimization. Industry and everything we do in life is always implies that we're trying to optimize everything we do. So just like your phone is getting smaller and smaller and makes more and more stuff, and it's like this in every sector of our life, including industry, construction, and everything. And we are basically producing instruments to measure stuff. And of course, you can't optimize anything that you haven't measured. Another driver of organic growth in the group is R&D. We're spending 5 to 6% annual revenue. It's more than the companies we buy were spending before, because they had to be super prudent, being family owned, and we can be a little bit more aggressive. And we've noticed at some point that whenever we had new products, we were always doing very well. So we decided to push our research and development. And lastly, what has been really a feature in the last couple of years, since we hired Mark Lavelle, is the optimization of every business. We tend to let these businesses very much autonomous within our group, with, of course, a lot of control of the figures, and always a good MD. But now we introduce a lot of things like leadership training and a lot of interaction between the various companies. But these are the three things which have driven organic growth. I have to say, some people ask me, David, you say you want to buy companies which are sustainable, and that's the main thing you're looking for, and not growth companies. And so you bought the wrong companies if you've achieved 8.9 compound growth rate. But really, I think we're explaining there what's the difference between stagnation, which stagnation means 3.5% because we operate in the world market, and that's typically the growth you get in the world economy. And the 8.9% that we've actually achieved is a result of pushing research and development, business optimization, and also the fact that we pick the best companies in our sector. And because our sector has very good long-term growth, well, we get even more if we pick the best companies. So acquisitions, our last acquisition is not big, but it's a very nice one, we feel. We're particularly interested in deposition because Quorum, who's one of our most successful companies, makes coaters. And for a while, we were thinking of developing a coater for material science, because Quorum is particularly interested in life science, and they're always being asked, do you have material science coaters? This company came up on our radar, and we bought it in December. So you see there the figures, it makes about 2.5 million sales, and a quarter of that is operating profit. By the way, this is a standard we always look for, 25% EBIT margin. We paid 2.3 million in cash. This included an earn-out, but the earn-out was paid immediately because the deal took a long time, so it passed the year end. And this is about, as you see, 4 times operating profit, which is typically what we'd pay for a business this size. We financed it with our bank lending. It's part of our revolving acquisition facility, and it's immediately earnings enhancing. Actually, it did start in December, but in a minor fashion. The vendor is staying for a year. He trained a new MD in the last few years who's staying with the business, but it's very helpful to have the vendor for another year to help us with the transition. You know, we're very disciplined in our acquisition policy. This is why we don't do a lot of deals. We're looking for companies which are strong exporters in a niche, If you don't export a lot, then you're not strong in a global niche because the UK is not an enormous country. And we like solid EBIT margins. So typically we're looking for 85 to 90% export and 25% EBIT margin. Why are we so interested in strong EBIT margin? Well, because our vendors are always very clever people and very numerate. And they know that if they have a 5% EBIT margin, they only need to increase their prices by 1% to increase their profits by 20%. And so why don't they do it? Because they can't. So typically, we see that companies with low EBIT margin are in a very competitive sector. It's a bit of a price battlefield. And we don't want these companies because we feel that the UK long-term is not well placed to win price battlefields because it's an expensive country to do business. So we're looking for companies which generate already profit and cash flow. Most of them have also a lot of cash when we buy them, which demonstrate that they have produced a cash flow over time. And we've been paying 3 to 6 times EBIT according to size. There's a big difference between companies making less than 1 million EBIT or more than 1 million EBIT. Less than 1 million EBIT, we have very little competition. In the past, we had none. And as a result of this, we are able to pay usually less than 5 times. Above 1 million, we have a lot of competition. We did 3 of these deals. We only paid 6 times, and 5 times. But we lose a lot of deals that we're bidding for because of the competition of large companies, but mostly of private equity. And there's always a private equity fund with money they have to spend quickly and prepared to pay a price that is, we find, excessive. We're allowed to borrow 2.5 times EBITDA. According to the proportion of EBITDA to borrowing, the margin escalates, but really we've been paying between 2 to 4% and closer to 2 in the recent past. Deals take a long time to incubate. Sometimes you have to court a company for years, and sometimes you have to try 2 or 3 times until you succeed. So you have to be patient, and thank goodness our shareholders have also been patient. The crystallization of these is very erratic, so you always look at a number of deals, and those you want to buy, well, you don't always manage, so you have to pursue a lot of dead alleys. We have a bit of an edge because we have an excellent reputation in the sector, and which is well deserved. And after 17 deals, people are starting to know about us, and people like to deal with us because we're honorable in that process. We treat people with respect. We never change the deal once we've signed heads of terms, and we are well financed. And when we sign the heads, we always have the security of the finance, which is already agreed with the bank. So once we bought a company, which is not often, but it does happen, so we immediately implement robust financial controls. They're not always terribly sophisticated in the production of figures, so we really need that, and Brad and his team are very good at that. And then the game is just to reduce debt and reinvest in further acquisition. Our game really as an acquirer is not an arbitrage between our multiple and the multiple we pay. There's a lot more an arbitrage on the return we get on our money, which, as Brad explained, is 31%, and what we pay the bank, which is more like 2 and a bit. So it's much stronger arbitrage, but it relies on really working to reduce that debt, and do more deals. From an operational point of view, we always need a really good MD, and we create a good environment for businesses to thrive. We do give them advice. Since Mark has joined, we give them also a lot of coaching, and we have a lot of activities, and that includes a lot of networking between different people in different companies, and a lot of benchmarking to encourage people to not be at the bottom of the scale in the judges group. Strategically, we of course have succession planning. In the early days, we didn't have a lot of change in MDs, but now every year we have to change several MDs because people get older. And we really basically help people, keep them focused on the long term. But these companies are run in an autonomous fashion. It is a very important feature of the Judges Group. So really, the outlook, we've talked about it. The order intake was slower in the early weeks of the year. The early weeks of the year don't contribute, their fair share of order intake, so we don't panic. Usually when the year starts slowly. But of course, the big uncertainty for this year comes from the virus. Nobody knows how long it will affect Britain and the country where we sell, which is basically the whole world. Just what I think we need to say is the way it affects us is getting orders, because we like to see people face to face, and we like to attend scientific conferences, and traveling, of course, is very restricted. It has been in China for a period and nice everywhere else, although China becomes easier. We are also affected in delivering these orders, and we're affected in installation, because often the equipment needs to be installed. It's strange that a lot of orders are still managed to go through, whether it's to China or to Italy. We've had some orders getting delivered. And of course, we have sometimes agents who are able to install. So it's not a complete stop, but it does affect shipments and deliveries. Our supply chain has been affected in a minor and manageable fashion. So it hasn't been a big crisis for us. And of course, a source of anxiety for us is the potential contamination of some of our staff. So we've been really basically promoting working from home for people who can, but in a factory, you need to be there. But what we feel is the main factor in how this will affect us is how long it will last. We work on a 3-month order book. So if we don't have a lot of orders in some zones, we can catch up. And if a factory has to be closed for 2 weeks, we're not selling consumer products. So people are able to work a bit more afterwards to ship what needs to be shipped. So in a nutshell, we have a difficult year this year, difficult for everybody. So we're not whinging. We're very confident in our business model. We feel that the ups and downs of short-term things should not affect our ability to conduct all aspects of our business model. And but it's going to be a tough year. The investment case, I think we have a robust business model. We pursue it with discipline. There's a lot of targets. We only do earnings-enhancing acquisitions, and we only do it when we're sure that it's going to be the case for the long term. We're in a business with good growth drivers. We're very well diversified. It's a bit less useful this year, but because the whole world is affected. But in a normal year, it really helps us producing stable results, and also the diversification by scientific application. We entirely focus on shareholder value, generating profit, cash, reducing debt, growing the dividend, and producing good return on capital that we invest. We've grown the dividend 10% for the first 14 years, and we've said the compound growth rate was 24%. And our shares are free of inheritance taxes, we believe, after holding them for 2 years. So we think it's a strong case for investing in Judges as a long-term investment, and we think we have a very good long-term future. Thank you, everyone, for coming to this unusual breakfast. I hope you all stay safe and healthy, and the next results presentation will be a traditional breakfast with a lot of food. Good luck to you all.